Welcome to Blueprint Boost for Contractors, the podcast that's your go-to source for unlocking the secrets to successful marketing, gaining valuable insights, and growing your contracting business with less stress. Your host is David Brooks, and he's thrilled to be your guide on this journey. As a seasoned expert in the contracting industry, David understands the challenges you face. That's why each episode is crafted to provide you with actionable strategies and proven blueprints to boost your business to new heights.
Hello, everyone. Welcome to another episode of the podcast. I'm your host, David Brooks, powered by Contractor Rhino, your go-to source for all your digital marketing needs and accounting needs in the home service and construction space. For this episode, we have a guest with us, and I'll allow him to introduce himself.
Hey, David, this is John Bartlett. How are you today?
I'm doing good, John. Thanks for joining the podcast. How are you?
I'm happy to be here, man. Happy to be here.
All right. No, excellent. So we have you. So can you let the audience know your company and how it got started?
Yeah, happy to. So, the name of the company is Brentwood Growth. We are sell-side advisors, merger and acquisition advisors. We work with business owners in the trades, both service providers and contractors that are residential, industrial, and commercial focused. That includes about 25 different sectors, things like HVAC, plumbing, electrical, roofing, garage door, lawn care, irrigation, mosquito and pest, chemicals, foundations, sort of the list goes on and on. Anything inside or outside of residential, industrial, or commercial building. Our clients fall into one or two categories. They're either thinking about selling the business in the near term, and they want to know what the value of the business is and who potential buyers would be, what a transaction structure would look like, and what a timeline would be, both to get the business sold and for them to transition out. Or they fall into a second category where they're thinking longer term, maybe 2 years plus, but they know they still want to sell the business one day. And they want to know what the value of the business is today and the kind of things that they need to be focused on to increase the value and increase the marketability of the business so that when it comes time to sell, they can have the best outcome possible. So we can work with guys that are thinking about selling in the short term, or they're thinking about selling in the long term, and they want to do some planning and they want to do some growing.
That's an excellent breakdown. That's excellent. Being able to be helpful on both sides of the coin and preparation for thinking about selling, getting that initial valuation, or whether you're at the point where you have your mind already made up and this is the direction that you want to go in.
Right, right. The thing that I tell owners all the time, and we have over 300 conversations a month with owners that are, reach out and they want to have a conversation. I say, life is complicated and it's like a puzzle that's on the table with a bunch of moving pieces. You got the financial side of your life, which is, all about numbers. What's my business worth if I sold it today, after I pay taxes, after I pay fees? How much would I net from that? How much money do I have squirreled away? How does the business fit into my overall financial plan? And that's very objective. But then you've got the life side of the business, which is much more subjective and oftentimes can be more complicated. It's things like, do I still like the business? Do I still look forward to going to work every day? Do I still have gas in the tank? Are there other things that maybe are more important in my life right now? Am I prioritizing my time properly? Is my marriage good? Is my family good? It's the life piece, and these pieces are moving around all the time. You just want to be sure that when the day comes and you've got clarity on the life piece, you just want to be sure when that day comes, the financial piece falls in place the way it should.
Mm-hmm.
And so, for most of us, the majority of our net worth is equity that we have in the business. And so, you know, knowing what the value of the business is, knowing how valuation is determined, knowing at least have a plan where you're building towards that. I think it surprises me the number of folks that we talk to that really don't know how do you determine a value of the business and what the value of their business is. And it's even more startling when you think about the majority of their net worth and certainly the majority of their retirement is the value of their business. And it'd be like having a 401k that's 80% of your net worth and you don't periodically check on what the value of that 401k is. I mean, why would you do that? You wouldn't do that. But I get it. I'm 67 and I started this business 5 years ago. I've owned and run a handful of businesses over a 35-year career, and I certainly know what it's like to buy a business, to run a business, to scale a business, to sell a business. Um, and I know, there's so much energy and so much investment that needs to be made. And, um, you're so laser focused on, keeping your clients happy and keeping your employees happy and being sure there's enough money in the bank to pay your bills and being able to have a little left over to, be able to pull out and pay yourself and, take care of what's going on at home. We just get so wrapped up in the day to day that it's hard to sometimes to step back and take a higher view. But it's important. It's important.
Yes, being in the day to day, like you said, it's almost like the analogy of using the 401k is really fits. I feel like it fits really good because you're so much, you're working in the business, but what is your exit strategy? What is, your, like you said, being able to have that assessment of the business, and eventually, what are your goals at the end of the day? What is your transition? So being able to get help and assistance with that is really important because you don't want to wait to the last minute and not have a plan.
Right, right, right. And even if you don't have clarity on what you ultimately want to do with the business, if the business is not growing, the business is dying. And so at the very least, as the business grows and evolves, it gets more complicated, you get more employees, the org chart changes, your management team changes, your role and responsibility as an owner changes. And even if you don't have a clear timeline and valuation number in mind as to what you want to sell the business for, certainly understanding and thinking about, as businesses continue to grow and as they continue to evolve, and as it takes more people to run the business, having a plan in place to help you properly manage the business is critically important. I did this for 35 years, and years ago, I bought a business. This was 1995. I bought a business that was doing around 10 million of sales, and we had about 30 employees. And over the next 10 years, we grew it from 10 million to 100 million, and we grew from 30 employees to 300 employees. And, I'd never done that before, and no one had, I was a friggin' history major in college. And so, I didn't know the first thing about running a business. But, I learned sort of on the job, and I made a lot of mistakes. But the thing that as the business grew from, 10 million of revenue to 20 million to 40 million to 80 million to 100 million, as the business grew, obviously it took more and more employees to run a business of that size. And as the number of employees grew, the org chart and the management structure continued to change. And my role as, a president or CEO, whatever the title was, that continued to evolve. And so I developed this concept, that there's a bunch of material on our website where I take businesses and I say that they fall into different categories based upon what the revenue level of the business is. And the revenue level determines what that business looks like in terms of, revenue, profits, valuation, employees, org chart, CEO, founder responsibility. So there's a level one business that's doing less than 500,000 of sales. There's a level two business that's doing less than 1 million of sales. There's a level three business that's doing less than 2.5 million of sales. There's a level four business that's doing less than 7.5 million of sales. There's a level five business that's doing less than 15 million. There's a level six business that's doing less than 50 million, and a level seven business that's doing more than 50 million. Now, most of us will never get to a level seven business, but that's out there. So as you take a business and as it progresses over time and as it grows and as it goes through these different stages, as it reaches each of those stages, the business looks different, and the employees look different, and the management team looks different, and the managers look different, and most importantly, what the owner's responsible for looks different. And so at the very least, even though you don't necessarily have, oh, I want to sell my business in 10 years for $7 million. Maybe that's not crystal clear, but knowing as your business grows what it's going to look like, and how you as a business owner need to change in terms of what your daily responsibilities are. Knowing that helps you prepare for that future growth.
Mm-hmm. Knowing and having and forecasting and being able to evaluate at what point, maybe you have a cutoff point. Maybe you say, okay, I have this goal that I want to get to. This is the revenue. Now I want to go ahead and start crafting my strategy or my plan for pivoting or, exiting, selling, or, whatever. You want to have
Yeah,
that.
and you don't have to sell the business.
Yeah.
Um, you know, I mean, there are a lot of folks that, they don't want to sell, but they don't want to have the stress, and they don't want to have the grind, and they don't want, they want more freedom, and they want more independence, and they want to be able to set up the business to sort of self-manage itself,
Mhm.
where they can be a more strategic CEO. And it's not like they're deep in the weeds, and they're in the grind, and they're dealing with employees, and they're dealing with upset clients, and it's that stress that wears us down. But, if you can get a business where, you've got a management team in place, and you've got KPIs in place, and you've got, metrics in place, and, you can go on a vacation for a month and turn the phone off, and you don't have to worry about the business, and, the business takes care of itself, and it's cash flowing, and you're getting these checks, and you've got a lot of freedom, and you can sort of come and go as you choose. That's I think we all want freedom, and we all want independence, and we all want the ability to make our own choices. And we don't want to, we don't want to feel like, the grind that we're in right now, we're going to be in that grind forever.
Mhm.
And so, a lot of the stuff that we're talking about is applicable in those instances as you get the business going and you've got your management team in place, and you come in for meetings every 2 weeks, and you're getting reports, and you have board meetings, and you've got a really good management team in place that you trust. And at that point, you're you're more of a strategic CEO investor, and the business is just kicking off a regular dividend for you.
Mhm. And like you said, a lot of people just want less of like a headache, less of the weight, on them, so they can go off and be able to do more, or have more time with the family, or feel like they could, step away and things won't crumble to pieces.
Right, right. You know, being an entrepreneur, it's an exciting journey, but it's a tough journey. And it's tough in the sense that, you feel like you're out there on your own. Um, you know, in a lot of instances, you don't have a partner. I don't mean a life partner. I mean a business partner, and you're sort of winging it. Um, and there's not a playbook. And so a lot of this stuff you're having to figure out through trial and error on your own. Um, we're all a little bit crazy if we want to be an entrepreneur, and we're sort of mavericks, and we're sort of control freaks. And that's why we decided to go down this path. And, you know, a lot of businesses, and I've seen this, they sort of reach the point where they're doing maybe 2 million of sales or 2.5 million of sales, and they just sort of cap out at that level. And I think the reason that they cap at that level is, if you're doing between 2 and 3 million of sales, depending on the business that you're in, you probably have somewhere between 8 and 12 employees at that level. And the original owner founder, he's still managing everything. He's got 8 people reporting to him, or 10 people reporting to him or her, or 12 people. And that's what's stressing him out, is the fact that, you know, he's got 12 people that he's having to worry about, and he doesn't have any help. I
Mhm.
mean, he has help doing the work. And maybe, there's a little bit of structure there. You might have a senior person here, a senior person here, but he doesn't have formal departments. And then he needs to grow, and he wants to grow, but he knows to grow, he's going to have to hire more people. And to hire more people, he can't take that stress. And so he realizes that he needs to begin to put departments in place, and he
Mhm.
needs to bring, managers to manage those departments. It might be a sales department, it might be a client service department, it might be a field management department, it might be a marketing department. Whatever the departments are, the business needs to create more structure to it. And he's afraid to do that because he doesn't want to give up control. And he knows hiring these managers, it's going to cost some money to hire a sales manager, or to hire a field manager, or to elevate your bookkeeper to a controller, or hire someone to manage your client support team, or bring someone in to really manage recruiting and manage the HR functions. I mean, that's going to cost some money. and they're afraid of making that investment because they know if they make that investment, if they don't grow, then that's going to cut into their profit. And they don't have the confidence that if they make that hire and make that investment, that the business is going to continue to grow at 20 or 30% a year in order to have the additional profits to pay that investment back. They don't have enough confidence in their ability to grow beyond that. And so they hang on to it so tightly because it's a control thing, and because they don't want to make the investment, or they're afraid to make the investment. And, at the end of the day, they're afraid to change. And they just, they cap out at 2 to 3 million, and they don't break beyond that barrier. It's the really courageous, CEO, founder, entrepreneur that wants to continue to evolve and continue to change, and continue to make the investment. They're the ones that are able to break beyond that $2 to $3 million barrier and become a $5 million company, a $10 million company, a $20 million company, whatever the number is. They're willing to change, and they're willing to make the investment, and they're willing to give up control. Now, I'm not saying giving up control means you don't know what's going on in your business. Of course not. You know what's going on in your business. There's reporting there, there's KPIs there metrics there, there's a regular rhythm in terms of what the management structure is. You've got visibility in everything that's going on in every aspect of the business, but it's because you put now this reporting process in there, and it's not because you're doing everything and everyone's reporting up to you. It's a different type of visibility that you have.
And like you said, it's a different type of visibility that you're going to be able to see, look at, and assess. And when you're going through the phases and just different steps of business and evaluation, you have to think about a few different things as you're on the journey. And so if I'm on the journey of, let's just say I come to you, John, and you give me an evaluation, but maybe I'm 2 to 3 years out, what advice or what direction would you lead me in?
Well, the first thing you've got to do is we need to do evaluation of where the business is currently. And in order to do that, we need to get the last 2 or 3 years financial statements. Let me back up. So at the end of the day, the value of the business is a multiple of the free cash flow of the business. The value of the business is a multiple of the free cash flow of the business. So in order to value the business today, we need to determine first, what is the actual free cash flow of the business? And then secondly, what multiple of that cash flow is a buyer going to be willing to pay for the business? So let's talk about both of those. First, the free cash flow. Forget what your tax return shows, because we all do the same thing from a tax standpoint. We get the business to pay for as much stuff as we can from a cash flow standpoint, and we want to show as little a profit because we don't want to pay tax. I mean, that's the reality of the world. But when it comes to a business valuation, you want to do the opposite. And so take your tax return and throw that out the window. We want to look at the actual profit and loss statements that come out of whatever financial reporting system that you're using. A lot of people use QuickBooks, and so we get the files out of QuickBooks, and then we will work with you to determine what the free cash flow of the business truly is. And when I say free cash flow, it's what the net income on your P&L shows, but then there's certain add backs and adjustments that need to be made to that net income number to determine what the actual free cash flow is. So things like owner's compensation, owner's bonuses, owner's distributions, owner's benefits, personal expenses that the owner's running through the business, non-critical, non-reoccurring charges that are coming through the business, dues and contributions, and we bought a truck and we bought this equipment, and that's it, all those one-time purchase things. You want to take all those expenses that you're running through the P&L, you want to add those back up, and you want to show you want to determine what the true free cash flow number is. So that's half the equation. The second half of the equation is what multiple of that cash flow is the business going to be valued at? Is a buyer going to be willing to pay? Now, at the end of the day, buyers are buying cash flow, and buyers want predictable, repeatable, growing, scalable cash flow. And buyers measure their risk in terms of, volatility in the cash flow or changes in the cash flow. Buyers measure their risk by the multiple that they're willing to pay. Okay, the lower the multiple from a buyer's perspective, the more risk that's inherent in the cash flow of that business, which ultimately determines a lower value that they're willing to pay for the business. If the businesses that trade for higher multiples from a buyer's perspective, there's more predictability, there's more certainty, there's more scalability. They're going to pay a premium for businesses that have more stable, growing cash flow because there's less risk in those businesses. And so you've got to first determine what the free cash flow of the business is, and you've got to next determine what multiple of that cash flow a buyer's willing to pay. Now, if you go back to the 7-level scenario that I talked about, as those businesses move through each of these 7 levels, and as the business gets larger, and as the client base gets larger, and as the management team gets larger, and as the cash flow gets larger, and as the dependency that the business has on the owner gets smaller because he's less involved in the day-to-day management of the business, as that business goes through those 7 levels, that multiple changes because there's less risk in that business. Mm-hmm. And so if you've got a business that's a level 1 business that's doing 500,000 of revenue, and it's a 20% margin business, and so it's got 100,000 of cash flow, a buyer might pay a multiple of maybe 2 to 3 times that. And so the business is worth maybe $200,000 to $300,000. Compare that to a business that's doing 5 million of revenue, that's kicking off $1 million of cash flow. That's got maybe 20 employees, got a management team, it's got a bunch of clients. The owner is beginning to pull away from the business. Well, there's less risk in that business from a buyer's perspective. Not only is the cash flow number higher, but the multiple that they're willing to pay for that cash flow is higher. In an example like that, they might pay a multiple of somewhere between 4 and 6 times. And so not only is the cash flow 10 times bigger than that smaller business, but the multiple that they're willing to pay for the business has doubled because the cash flow is more secure. And so you're sort of getting a double bump from a valuation standpoint. You got a higher cash flow number and you got a multiple that's twice as high. And when you plug those two together, it becomes a bigger number. And so I mean, what we want to help owners realize is, I'm here and this is what my business looks like today. I want to get to here. And if I get to here, this is what my business is going to look like. This is what the revenue number is. This is what the cash flow number is. This is what the multiple is. And so all that makes sense from a financial standpoint. But to get from here to here, I mean, a lot of things need to change in my business, and I've got to put a plan together to be able to execute on that, um, to hit what the end game is. And so you know where you are today, you know where you want to get to in 5 years, 7 years, 10 years, whatever the timeline is. But there's a gap in between, and you've got to put a plan together over the period of time that makes sense for you to execute on that plan to close that gap.
Mhm. I love how you just broke all that down and just walked through those steps and what you need to be looking at and thinking about for steps moving forward. Love it.
Well, we do the easy part. I mean, it's easy for me to, for us, we get the financial statements and we drop it into an Excel spreadsheet, and we run the projections out and we put it in a PowerPoint deck and we put a pretty bow on it and we send it out and say, here it is. But we're gonna work with these guys, and we're gonna help them monitor, and we're gonna help them prioritize, the initiatives that they're sort of biting off, step by step. But I mean, they're the ones that have to execute on that plan. And we'll help them put it together, and we'll encourage them, and we'll give them support, and we'll hold them accountable. But they're the ones doing it.
Mhm.
And I mean, nothing makes me happier than being able to have these conversations to help these business owners sort of understand where they are and where they want to go, and put a plan together, and then help them monitor that plan, and then see it all come together over time.
Mhm. That's excellent. It's, having that help and assistance, and you say, "Hey, look, I'm just doing the easy part."
Doing the easy part, man. I'm putting spreadsheets together.
So, as you're, assisting different owners, businesses with the process,
Mhm.
what are just some, final key points and takeaways and recommendations that you would be able to give?
Um, know your current valuation. Know what drives valuation. Have a plan. Have a 1 year from put a projections together. 1 year, 3 years, 5 years, and know what that looks like. And I mean, you can assume 20%, 30% revenue growth. You can make assumptions as to what your gross margins need to be and what your net margins need to be. You can put all that together, and it's what I'm talking about. It's easy to put an Excel spreadsheet together and say, okay, I'm doing $1 million now, and my gross margins are 45%, my net margins are 20%, and I'm going to grow this thing at 30% a year, and my margins are going to stay the same. And if I do that, my cash flow is going to be this and my valuation is going to be this. So do that, but have a plan together, a strategic plan. These are the things that I need to do over the next 12 months to get me a step closer to where ultimately I want to be. And so it's knowing where you are, it's knowing where you want to get to, and then it's biting that total journey off in manageable chunks so that year by year by year you can keep whacking at it.
Mhm. Thank you. That's valuable. That's valuable advice to be able to have and work towards that goal. Establish that goal, establish your baseline of where you want to be, where you want the business to be, and slowly start to execute and formulate and strategize a plan. Whether that is just selling or staying inside of the business and just trying to take some of the things off your plate.
Just chill, man. Just chill.
Yep. Well, John, that was excellent. Thanks so much. Can you tell the audience where they can find you at?
Yeah. So feel free to call me if you want to. It's 908-377-7807. Email is jbartlett@brentwoodgrowth.com, or if you can go to our website, which is brentwood-growth.com. Either way, if there's anyone out there that would just like to talk, or we can do a valuation for you. We don't charge anything for the valuations. Everything we do, we only get paid on the back end if a business sells, and so we're just trying to help people as much as possible. Grow the value of their business, and if it comes time to sell, we hope they'll think of us.
All right, excellent. I appreciate it. Thanks so much.
Okay, brother. Have a good weekend.
Yes, you too.
Okay,
Thanks,
man.
thanks everyone for tuning into the podcast. Make sure you tune into the next episode.
Thank you for tuning in to another episode of Blueprint Boost for Contractors. We hope you found today's insights and strategies valuable for your contracting business. If you enjoyed the episode, don't forget to hit that subscribe button and please leave us a review. Your feedback helps us bring content that truly matters.